is Other Blocks Trading Group. In today's video, we want to consider the concept of market structure. But before we dive into the video, a quick disclaimer. I am not a financial advisor by any means. Neither do I have the capacity to advise you on what to do with your finances. Forex trading is a risky business. So do your due diligence before you put your hard-earned money to risk. This video is for educational purposes only. So don't take the contents of this video to mean investment advice. Okay, having said that, let's dive straight into the video. Now, what is market structure? Market structure is the movement of price on the chart relative to the market swings high and swing lows. Market structure is crucial to trading the forex market successfully. As a matter of fact, market structure is about the most important tool that any trader will look to understand for trading the forex market. There are three structures in the market, majorly three structures in the market: the uptrend, the downtrend, and the sideways market. But in today's video, we want to only focus on two of the three structures, which are the uptrend and the downtrend. In an uptrend, the basic rule in an uptrend is market creating higher highs and higher lows. In a downtrend, you want to see market creating lower highs and lower lows. Look at the diagram here. Market came from here and created a high, and then market retraced back down, created a higher low. Why is this called a higher low? This is a higher low because this low here, look at my cursor, this low here is higher than this previous low. And then market pushed up to break this high and created a new higher high. Market now retraced again and created a new higher low. Push up again to break this high to create a new higher high. Now, what we should expect from the market with this structure now is for price to have come down and create a new higher low for a push up to break this previous structure and create a new higher high. But market didn't do that. Market instead came down and broke this, the last higher low before creating this higher high. It broke it to the downside. Immediately that happens, my focus and the focus of any trader who understands market structure should change from buying this market to looking for opportunities to sell. Why is it? It is because the last significant higher low has been broken, and that is known as break in market structure. So the market created a low which is lower than this previous low here, and then went ahead to create a lower high. A lower high. Why is it a lower high? Because this high is lower compared to this very high here. And the market came down again, broke that lower low, creating a new lower low. This indicates that we are now in a downtrend. Now, let's go to the chart. The structure I have just shown you can be found on any time frame. It can be found on any asset class. So, now, look at this chart. Just one more thing, guys. When you are trying to read market structure, please make use of the higher time frame. The higher time frame trumps every other time frame below it. So it is important that you use higher time frame. My favorite is the daily time frame, but it's up to you, depending on the type of trader you are, what time frame you are comfortable with. Now, to the chart now. Look at market from this point. We are coming from this point. Market went up, created this swing high, and then retraced to create a swing low. This swing low here. Look at the swing low. Created this swing low. Now, market went ahead and broke this swing high, where you find this our arrow here. It broke the swing high to the upside and retraced again to form another low. This low is lower than the previous low. And then market went up again and broke this swing high to create another higher high. Look at our arrow here. Follow the arrow. And then market retraced again and created a new higher low and broke that structure again and went up and created another higher high. Guys, this happens every day in the market, and it happens on all time frames and asset classes. Now, when market created this high here, market now came down. Remember, the last significant higher low as price was going up is this low here. Market now came down and broke that low to the downside. It broke the low to the downside and created a new low, which is known as lower low. Take a look at the arrow. Why is this one called a lower low? It's because it is lower than this low. Immediately this break of structure here happens. This is a break of structure. Immediately that break of structure happens, my focus will change. My bias will change from looking to buy in this market to becoming a seller. Why? Because a break of structure had just occurred. So market came down and created this lower low, went back up and created, look at it, it went back up and created a new higher high. It created a new lower high. Why is this high here called lower high? Because it is lower compared to this high here. So, and then market continue gyrating, creating lower highs and lower lows, lower highs and lower lows. Now, I want you to understand the simplest way to understand how to read market structure is to focus on the swing highs and the swing lows in the market. The swing highs and the swing lows are important levels in the market that all experienced traders in the world and professionals are looking at. The swing highs and the swing lows will offer the trader low risk entries and high yielding rewards. Your duty as a trader is not to know what happens in between a swing high and a swing low. That's not what you are supposed to focus on. What your focus should be is the swing high and the swing low. If you are just starting off trading, then you can mark out your swing high and mark out a swing low with an horizontal line. If you are in an uptrend, immediately the market breaks your swing high horizontal line, it tells you that a structure had been broken, meaning that the market will continue with its uptrend. But if price comes to your horizontal line below, that is at the lower, the lows, the higher low in the case of an uptrend, that horizontal line you mark there, if it breaches it downward, it tells you immediately that your buyers should change from being a buyer in the market to looking for opportunities to sell. So the swing points are very important for you as a trader. Whatever happens in between the swing high and the swing low of any market is not important to you. It is simply noise. The most important thing for you to watch is the swing high and the swing low. Once you can understand that, then reading of market structure becomes very easy for you as a trader. Now, in an uptrend, where do you buy from? You buy from the swing low. You don't buy from the swing high. Always buy from the swing low. The swing low, like I said before, offers you a low risk entry. In a downtrend, where are you focusing to sell? You focus to sell from the swing high. The swing high offers you low risk entry. You don't look to buy when the market has moved away from the swing high. That will mean chasing price. So please try and understand these key points. These key points will keep you away from being confused with the gyrating of the market. Focus on the swing highs and the swing lows. Once a swing low in a downtrend is broken and market reverses back, what you should be looking for is sell opportunities at a new swing high in the case of a downtrend that you can take trades to continue with the downtrend. I hope this helps, guys. Market structure can be very confusing, but with the points we have raised here, it will simplify things for you. Thank you.